I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Are we about to see a big economic blow based on real estate prices?
Yeah, it's, are we about to see a blow? I was listening to a couple of news reports today, and I am so disappointed that they're not expressing the magnitude of what is probably going to take place here over the next, starting over the next few months. Canada, the Canadian, let's just simply look at Canada Bank stocks. So I am not a stock analyst. I don't pretend to be. I don't know how stocks, how they value these companies. I don't read the inner workings. The only parts that I follow are the mortgage debt and the loan-to-value ratio of the mortgage book that a bank has. Now, I historically have only tracked those things because they are checks that we have that we can check, we can verify what our other assumptions about the market, whether they're correct or not. So let's look at just the banks. Apparently, a lot of the bank's profits are an increase in share value, in other words, rising share prices and dividends, is a contingent upon an increasing mortgage book. In other words, the bank will continue to book more and more mortgages, make their mortgage book larger, and that nets more profit for the bank, which means a higher share value, higher dividends, and the stock prices obviously are up. Well, that's going to end, folks. There is this, you've heard this, all this GDP to income. You've heard that, I'm sure, Jim, over and over and over again, GDP to income. Well, that is really a metric created by economists who don't understand that if we do not have growing mortgage debt, your housing prices are falling. That's just simply how it works. If the mortgage books at these banks are not growing, it means their housing prices are dropping. So that means the bank is going to be less profitable because its mortgage book is shrinking. At the exact same time, the loan-to-value ratios are falling because housing prices would be falling. So it's actually a double whammy on a bank. Now, we're talking about banks here. This goes across the entire economy. Home Depot is another not going to say stock, but it's another company that is really impacted by the housing market. And we know, from our own metrics inside, we know as the housing prices are going up, people are going to visit Home Depot more. And Home Depot obviously goes up in price, and their shareholders are happy. But the same thing happens on the way down. Now, people may still go there and do their normal repairs, but what they're not going to do is, because they're not going to have the money available, is go to the Home Depot and put in granite countertops. So that part of the economy would be held back. The provinces derive huge revenues from land transfer tax, the trading process of homes on its own. CRA generates some tax revenue from the trading of homes. Real estate incomes are based, real estate agent income, broker income, mortgage broker income. These people all are generating money for the economy. When the housing market slows down, as it already has been now for a few months, the overall economy is going to be impacted by it. And without consumers having access to borrowing more money, they're not going to be able to spend their way out of it this time. This is why we leave it to economists or experts in the field of a national economy to say whether or not a recession could take place because of this pending correction. It is my belief, Tom, like my honest belief, without being an expert in that field, because I know what's happening with the market and we know where it's headed, that, yeah, we are talking a massive consequence to the Canadian economy. Projected deficits of the governments are going to be far worse than what they're projecting. It could be a lessening of our credit worthiness by the credit rating agencies, which in turn mean the cost of money for our governments and our corporations goes higher, lowering profits once again. Our economies are not structured to handle a slowdown of this magnitude, and they're not structured to handle a decrease in mortgage debt. That is simply the truth. There is no way to resolve that at this time. Maybe a decade from now, after we go through a period of harm, it will be fixed. What we do know is in 2007, 8, 9 in the States, the same thing happened. Well, not the same thing. The American version happened, and here we are 10 years later, and they have changed nothing. So, yeah, we're really, really concerned about this, and we know that on the same way as prices rose over the last 13 years, through the multiplicity of trades, in other words, the illusion of house price growth, it also works in the way down too, and that should be concerning for everyone.
As a homeowner, what should you be concerned about right now?
Well, what you should be concerned about is that the equity that you have in your house right now that is available, that's sitting in your house, you should have been accessing that equity, and you should have been in consultation with a financial advisor, with a long-term strategy with that equity. So let's say, for the sake of the argument, that you have own $1 million home. I'm just going to use $1 million because it makes numbers easy. And you had 50% of your house was a mortgage, 50% was home equity. If housing prices correct 10%, you lose $100,000 of your home equity, which is 20% of your net wealth is gone that you have tied up in your home. Your mortgage is still at $500,000. It doesn't go away. If you had gone ahead and accessed some of that equity, say you had taken out $200,000 and you had invested it in a next to no risk investment with a financial fee-based financial advisor, and you were able to earn 6% on that money. That means you would have netted a $12,000 gain in 1 year. That would have offset $12,000 loss in your home equity if housing prices fell. Now, for the people who've been in their houses longer, the boomers who may be mortgage free, the opportunity was even greater. And what everybody should understand is that if you invest in items that are compatible with home ownership, in other words, you take some of your home equity and you invest in items, stocks or investment vehicles, bonds, whatever, that are tied to the housing market, then you don't lose because they offset one another. You minimize your risk for loss of net worth. I know the universal, and let's not forget, if you borrow that $200,000, it's also tax deductible, the interest on it. So let's just not forget that little factor either. So the risk is so low when we're sitting here below 3% interest rates on 5-year terms. To not have taken advantage of that. I know the reason why people haven't done it is because they haven't, they've always been felt that they've been misled by a a stockbroker who just wants to sell us stocks, or a real estate agent who just wants to sell us real estate so they can make money. But with our programs, because we're independent, there is no benefit to us to recommend doing something or not doing something. When we sit down, we just look at it logically, we break it down, and we present the options to the people, which they then can go out and decide what they want to do with. We're tracking their home price all the time, because that has always been the greatest fear. Oh, I'm going to borrow against my house, and then my house is going to drop in value, and I'm going to even owe more money on my house than with its price falling at the same time. Well, my answer is very simple. Well, then you just simply sell your investment if that becomes a problem for you. You throw that back down in your mortgage, and it's neutral. It's just a culture of fear based on being taken advantage of by everybody over the last 2 decades, and our platform makes that you don't have to worry about that anymore. You just simply get the facts in front of you. You make a rational decision. Talk to your lawyer. Talk to your accountant. Talk to your financial advisor. You got like 5 people protecting you as long as you give them the right to question. And it's a great way to go forward.
We'll have more with Ross Kay right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with Ross Kay. Ross Kay, why do you feel the figures that we get from the Terranet National Bank about real estate are not to be trusted or maybe distorted in some way?
Well, because they're stale dated, and what that means, and what I mean by that is that when we're looking at the Terranet National Bank, they just released last week saying that prices were up 14.9% year over year. That's what their aggregate. If you went to the Globe and Mail website, you'll see that they say the average Canadian house, this is what the Globe has used, and they use Terranet National Bank metrics, is $671,000. So that was $200,000 higher than what the average selling price was in Canada last month. And the average selling price is already inflated. So all of these numbers are so inflated, it's really no wonder that home buyers, don't know what ends up. Where the problem that we have right here is that this particular last week, the lead economist on this with National Bank was on the news radio show, and he let it slip that we could see a 10% correction in the Terranet National Bank price over the next little while. Well, what I'm going to tell your listeners is this: that drop has already taken place. The valuations this week, Canadian banks are going to release their quarterly shareholder reports. All the banks do it this week. They all use Terranet National Bank. They are going to release quarterly report at the peak of the Terranet National Bank House Price Index, which is used to score their loan-to-value ratios on their uninsured mortgage debt. All of the rating agencies around the world rate the Canadian banks based on that metric. Terranet National Bank, in the news last week, quietly admitted there's going to be a 10% correction. 10%. That means if the loan-to-value ratios that they're showing for some mortgages are 70%, they're actually 80%. So, and an 80% loan-to-value ratio is high ratio. It's at the bottom end, but it's right at the high ratio. You move up or down 1% and you're into high ratio financing. So this is where this faulty metric comes into play. And everybody's confused. Even the reporters. You know, some of the reporters last week came out, or journalists, whatever the proper term is, they've come out and said, well, you know, we're so confused because they're all throwing these different numbers at us. We have Canadian Real Estate Association average selling price, Canadian benchmark price, Terranet National Bank HPI, Royal LePage median sale price, REMAX house price forecast, and then you have every economist in Canada who gives you some version of whatever they got of one of those metrics. They're all wrong, which is why you have a correction, folks. They're simply wrong. Their calculation methodology is wrong. You cannot do average prices or house price indexes the way that they're doing them. You don't have to believe me, as I've said in your show before. The OECD has a 133-page report where they went over this problem, and they couldn't come up with a solution. Right now, Statistics Canada is spending, I think it's about $300 million, trying to come up with a solution to this problem. Down in the United States, the property portal called Zillow.com, they're offering a $1 million reward if you can give them the proper algorithm to come up with a true property price index. And what I'm telling your listeners is these guys can't do it because they don't understand the basics of a housing market. I'll explain it to you this way, Jim. In Toronto this week in July, for July, the Toronto Real Estate Board said that housing prices had dropped 19% from a year ago. I was on CBC last October telling everybody that housing prices were going to drop 17%, not 19, 17%, because of a new mortgage rule that had come into place. The reason I said that is because it was impossible for it not to happen. That rule automatically changed how much money people could borrow, so the home buyer is going to buy a cheaper home. It's got nothing to do with the average price of a home. It's a buyer side metric. And if your buyers can only be approved for a mortgage at $50,000 less, that means the average purchase price is going to drop by some factor. If it was all first-time buyers, it would simply drop by $50,000. What you saw released in the Greater Toronto area for the Toronto Real Estate Board is it took from last October until June, July of this year for their market to roll over, meaning a market progresses. We call it trading periods. So we've talked about the trading cycle on your show before, but within a trading cycle, they're trading periods. And these periods repeat themselves over and over again. It took from last October till June, July for the GTA trading period to get back around again to where the first-time buyers were going to be concentrated, which is the first time that mortgage rule change got reported. It took that long for that mortgage rule change to get reported. It's another one of the confusing factors because they use these seasonally adjusted numbers, and why we tell you can't use them. Because these trading periods range anywhere from 8 to 18 months, and they change from province to province, and they also can get shifted one way or the other, depending upon any changes that take place, well, literally the hundreds of changes that take place in a housing market. That could be unemployment, price of oil drops. It could be rules changes to mortgage financing. It could be an interest rate change. It could be a zoning change. All of those unique features impact what's going to happen with prices. If you aren't measuring all of these things, that's why the home buyers are so confused, and home sellers, and why they're at such risk, is because nothing has been out there that has ever measured all of these different components and then be able to give you an honest forecast. And I always go back to this. If what I'm saying wasn't true, I think there would be an uproar on our forecasts for the people who have dashboards with us. I think there would be a major uproar if our forecasts weren't coming true. Well, our forecasts come true all the time because you can't avoid it. This is going to happen. This 10% drop that the National Bank said for the Terranet National Bank Index, it's already taken place. They're going to be reporting that sometime in October or November. But we know it's already taken place. We had a call from a short seller in the United States yesterday. And not yesterday. That would have been Friday, right? Friday. And he wanted us to know about shorting Canadian banks, what our opinion was. Well, I can't tell you what to do with shorting banks. What I can tell you is I know what's going to happen to their mortgage book. I know when it's going to happen. I know what's going to happen to the loan-to-value ratios. I know how the Terranet National Bank Index works, so I know when you're going to get that reported. If you can do anything with those numbers in terms of shorting or a Canadian bank stock, you do whatever you want with them. I don't know how to do it. All I can tell you is I know where they're going to be because it is unavoidable.
We'll have more with Ross Kay right after this.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Ross Kay. Ross, somebody put out a news release saying you'll do better if you use a realtor. You'll make more money on the sale of your house. Is that really true?
Okay, so, I mean, obviously I was a realtor. As you know, for 27 years, and I was a third-generation realtor. What I'll tell you is this. My client never paid me, ever. If you were listing your house for sale, you never paid me. Our marketing system, strategy, whatever you want to call it, was so good that if we didn't get you more than what other agents were quoting you as the market value for your home, enough to get our commission, we were not going to charge you. That was our agreement from 2002. It was 2002 we brought that policy out until when I left in 2013. We were paid on every deal. We were paid the commission we wanted to be paid, and all of the buyers paid the price that we wanted to get them to pay for our listings. Problem. There's your problem, Jim. I think what you're talking about, if I'm not, you're going to hear about it now. There was just a major study done in the United States. 1.2 million sales were supposedly reviewed. They were not reviewed by Organized Real Estate, not NAIR or the National Association of Realtors. This review was not done on the behalf of a real estate franchise brand like RE/MAX or Century 21. This was an independent analytics company who just simply wanted to find out if you got more money selling your house privately or if you netted more money selling with a realtor. What these 1.2 million sales showed was that the seller netted the exact same amount of money in their pocket. On average, properties listed with realtors sold for 5.5% more than for sale by owners. Sounds kind of innocent. Okay, sounds okay. Well, then I'm going to hire a realtor because it doesn't cost me anything. Okay. What everybody needs to understand is this. That meant 1.2 million home buying families paid all of the commissions. The sellers did not pay a nickel, because if you had sold it yourself privately, you would have got the same amount of money in your pocket. But using a realtor, you got the same amount of money in your pocket, only because the home buyers were conned into paying a higher price by the realtors. This has gone on for 60 years. Only one side of a transaction has ever been represented. Without our home buying program, okay, without the strategy that we employ, you will never get the lowest price on a home. You can Google it right now. Your listeners can Google right now and see what the listing agents all say. Highest amount of money, quickest time possible. What the buyer should try to find is one single realtor anywhere in North America, especially Canada, that says, I'll get you the lowest price possible. You can't find it. It doesn't exist, because your listeners are going to be shocked to learn that is illegal in every province in Canada. It is illegal for a realtor to get you the lowest price possible for a home. It's so illegal that in almost all provinces, you cannot even offer a financial incentive to your realtor to get you the lowest price possible. On the other hand, sellers can pay their realtor more money if the realtor gets them a higher price. The buyer cannot pay the realtor more money if they get them a lower price. All of your listeners need to understand, if you go out and purchase a home under the traditional strategy, you, the buyer, will pay all of the commissions that the realtors get, both buyer and seller commission. You'll be paying them all. You'll be paying for it in the sale price. You will have a mortgage for the next 25 years where the last mortgage dollar you pay off is that commission, because it was included in the price you paid. Not only that, your property taxes are going to be higher forever because you paid that real estate commission in the asking price. Your CMHC fees, if it's a CMHC loan, will be higher because it's been paid. Now, I think everybody's entitled to be paid if they do a good job, and they do it great. But if a real estate agent, I'm hiring a real estate agent to work with me as a buyer to get me a good deal, and that real estate agent cannot even say, I will get you the lowest price possible. You have a major problem. Can you imagine going onto a car lot or hiring someone to go out and find you a car, and you couldn't reward them financially if they got you a better deal on one? That's what it is with real estate. So the comment about, do real estate agents get more money than for sale by owners? I will answer yes. In most cases, that's going to be true, and I'll even accept that study, which was 1.2 million home sellers. They returned 5.5% on average higher, meaning the sellers netted the exact same thing in their pocket. Okay, I'll admit it all. Let's just take that as fact. The flip side is, though, home buyers purchasing a realtor-listed property paid a 5.5% premium. 5.5%. On a $1 million house, you paid a $55,000 premium if you bought it from a realtor versus if you bought it for sale by owner. That's what this largest study in the history of real estate just said, except it's not being presented to the public that way. It's being presented, it's okay, hire a realtor because it doesn't cost you anything anyways. They're going to get you the extra money.
Is there any way for a home buyer to get help to try to find a lower price?
Yes, I can get, with the right strategy, okay, it's a strategy. The reason we have our buyers program, Tom, is, Jim, is so that we can have a strategy out there so that people can use this strategy with pretty much any real estate agent. The real estate agent can't screw it up. You have to understand, you have to accept, your real estate agent legally cannot fight to get you the lowest price possible because they can't advertise that. It's against the law. That is why you can't do a Google search and find a buyer's rep out there saying, I'll get you the lowest price. But you can find every listing agent in Canada telling you they're going to get you the highest price possible. So you have to enact a strategy where you are the one driving the car. You're the one driving the strategy. You're the one giving the instructions. We looked at all those crazy bidding wars in Ontario this year and out in British Columbia last year. And we just sit here laughing. Oh, not laughing, kind of crying too, knowing that the people are entering these bidding wars, buying houses without building inspections, without conditional on financing, without the house knowing if there's mold in the house, without knowing if the price of the property is fair or not. They were buying in these bidding wars with all these terms. When in 2017, technology is in place that never had to happen. So you ask, okay, well, if it didn't have to happen, why was it going on like this? Like, why were so many people financially destroyed? They're going to be financially destroyed when this gets worked out. Why did it happen? Because the realtors legally could not provide you the strategy that you didn't have, so that it didn't happen to you. A realtor cannot even recommend a building inspector without breaking their provincial trading legislation. So you can imagine what it was like for me for 27 years, telling my clients the truth about this every single day when they were buyers, me telling them the truth. The strategy that I had to enact as a realtor was, you asked me for a name of a building inspector, I would give you 3 names, and then I would make the comment, and I usually like to write the names in order that if my sister was going to use the services, who I would rank. But don't take my word in it. So they would know the number 1 name on the list was probably someone who we would recommend. But we legally couldn't recommend it. So we had to use a workaround. Same with lawyers, same with mortgage brokers, same with banks, because there's certain banks we don't believe homeowners should be getting their mortgages from. The banks there are certain terms in those mortgages that if you're going to accept, then you at least need to be told about. But that doesn't happen. So yes, there is a black and white strategy that allows none of these bad things to happen to you when you're a home buyer. It costs you nothing because the money's refunded as long as you buy a house. I mean, look, in Ontario, we're using Mike Holmes from HGTV for our home inspection. Our clients don't even pay for it. It's free. Like our members, they don't even pay for it. It's free. But it's all part of the strategy. As long as you lay it out in a strategy, all of these things are possible. But if you go with a realtor on your own, it will never happen.
And how does a person know what those strategies are?
Oh, if they're a member of the Wealthy Homeowner and they want to enter the buyer or seller program, then that's what they do. And those program costs are all refunded, by the way. If they buy a house or sell a house, those program costs are all refunded. It's part of the strategy too. And that's the only way to access them, Jim. Like, I mean, I can't say anything otherwise. That's the only way to access them. These strategies are so powerful that the proprietary nature, like the knowledge behind even how we do a home inspection when one of our members is buying a house, even that one single component is done in a specific way. We don't let people who are using our buyers program, one of the requirements is, in order for you to get your program fees refunded, you have to have an appraisal done on the property before you buy it. And that appraisal you don't pay for. Okay, that's how what is available in today's world. They actually, with the program that we have, they actually get 4 different appraised values on any property that they're going to buy. So there's none of this blind bidding going on. You have 4 separate appraisals done on a property, one of which you can use in a court of law before you purchase a property. Not after the fact, before. And the best part is you don't even pay for it. All this is possible in today's home trading environment. But if you don't have the strategy, you cannot enact it. And even if a realtor knew parts of it, a realtor could not enact it because they would be violating rules and regulations or the Provincial Trading Act where they're working.
Ross, always interesting talking with you, and at least now we know there is hope for home buyers to get a good deal.
Yeah, our goal here going forward, Jim, is obviously our members is to make them as wealthy as possible by them having information, but it is to revolutionize the buyer side of the real estate transaction. And I will tell you, if you have any realtors that are listening to the show and they want to be part of a revolution going forward where you finally, for the very first time in the history of Canadian real estate, start to treat buyers with the exact same respect you can treat sellers. In other words, you want to work with a buyer and get them the lowest price possible, drop us an email.
My guest has been Ross Kay. He's a home ownership consultant at thewealthyhomeowner.ca. By the way, what's your email?
It's rosskay@rosskay.com.
You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Questions for the show or our guests like Ross Kay can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.